The session is being recorded now. Good morning, all of you. I am Priyadarshini. I am the founder of Adhyapana Academy, which is located in Mylapore. Apart from this Adhyapana Academy, I am a faculty at SARC. For those who have done your intermediate at SARC, you should be aware of me. I am Priyadarshini and I am there for the past 8 years. Apart from this, I have 15 years of experience in teaching on an overall basis. So today, it's happy to meet you all. I will be giving a demo on strategic financial management. I will also be giving a demo on cost management, which is strategic cost management. So you can watch the demo and later ping me for details of the class. This demo is for June 2023 exams. The class will begin immediately after Pongal holidays and we will complete the portions before the end of April. Okay, so to start with, strategic financial management. SFM. Okay, so let me tell you the content of this paper. You will have capital budgeting. Then you will have leasing. Then you will have security analysis and portfolio management. You will have mutual funds, derivatives, and Forex. All these topics together. You have some theory also about risk management. Okay, so excluding theory, the practical aspects are these 6 topics. Okay, so today I will be giving you a demo on a familiar topic for you, but an extended concept, which is from capital budgeting. Today I will be giving you a demo on sensitivity analysis with respect to capital budgeting. So sensitivity analysis with respect to capital budgeting. Right. What is this sensitivity analysis? Sensitivity analysis is the sensitivity of factors, measuring the sensitivity of factors. What is this measuring sensitivity of factors? Measuring the impact of the change, impact of future changes on the profitability of the project. The sensitivity of factors is measuring the impact of change on the profitability of the project. So you all should be aware of the basic NPV by now. What is NPV? NPV is net present value. What is this net present value? It is the benefit derived from the project in present value terms, where it is the sum of present value of cash inflows minus sum of present value of cash outflows. As part of inflows, you will have the cash flows from the project. I am not telling you the basics. As part of inflows, you will have the cash flows from the project. Then you will have the terminal flow. As part of terminal flow, you will have scrap realization. You will also have the recovery of working capital as part of terminal flow. You will have scrap realization from the asset and the recovery of working capital. As part of outflows, you will have the cost of the project and you will also have the working capital invested. So this is NPV. What is this NPV? It is an estimated value. This NPV is the benefit derived from the project, but that benefit derived from the project is only an estimate. It is not actuals. So what am I going to do? This estimate is subject to fluctuations in future. See, nothing can be predicted. We thought COVID is over. It is coming back now, right? So nothing can be predicted. Hence, what we do, we have, suppose say, just an example, I have a project for a cost of rupees 1 crore. I evaluate the NPV of the project. I evaluate the NPV of the project to be positive. Hence, what do I recommend? I recommend accept the project. Suppose the NPV from the project is positive and the life of the project is 5 years. If the life of project is 5 years, 5 years is a huge term. We do not know what is going to happen tomorrow. Now, why am I going to bother about? Why am I going to take a risk about 5 years? In which case, I will have to measure the sensitivity. What is this sensitivity? This sensitivity will consider the fluctuation in various factors. Fluctuation in various factors contributing to the NPV. So, what could be the fluctuation in various factors contributing to the NPV? Number one, it can be fluctuation in revenue. You will not be getting the expected revenue. You can get something more, you can get something less, because NPV is based on estimate only. Fluctuation in revenue. Number two, it can be fluctuation in cost, variable cost or fixed cost. It can be fluctuation in cost. Number three, it can be fluctuation with respect to life. Suppose the life of the project is 5 years, and if the project is going to end in 3 years itself, there is no written agreement, there is no written statement that you should continue with the project for 5 years. So if there is a fluctuation in life. Next, if there is a fluctuation in the discounting factor. What is that discounting factor? It is the cost of capital. What is that cost of capital? It is expectation of investors from the project. If there is a fluctuation in discounting factor, what will happen? All this will affect the NPV, correct? How long or this affecting NPV? I am going to consider only the adverse effect when it comes to sensitivity analysis, because if it is a positive effect, I will be happy. I will not be worried if it is a positive change. I will be worried only if it is a negative change. Only if the effect is adverse, I will be worried about. So I will have to measure sensitivity. While measuring sensitivity, there are two ways of measuring sensitivity. One is total sensitivity, where I will equate NPV to 0. I will equate NPV to 0, keeping one factor to change at a point of time and other factors remaining constant. While measuring sensitivity, it is only one factor which will change at a time. Other factors will continue to remain constant. There are two ways of finding sensitivity analysis. Now, I find sensitivity keeping one factor fluctuating at a point of time and NPV equal to 0. Suppose I find the sensitivity of revenue as 20%. The sensitivity of cost as 15%. The sensitivity of the discounting factor as 35%. It is not 20 plus 15. It is all random numbers which I am writing now. Which is most sensitive? If a question comes up as, yes, you have sensitivity analysis as part of your syllabus. If they say, which factor is most sensitive considering these three? Which factor is most sensitive? I already told you, sensitivity analysis is to measure the adverse effect on a variable contributing to NPV. Sensitivity analysis is measuring measuring the adverse effect of factors contributing to NPV. Okay. See, here I am talking about adverse effect. When will NPV be 0? NPV will be 0 if the revenue falls by 20%. I will do a numerical example after explaining the concepts. NPV will become 0 when the revenue falls by 20%. NPV will become 0 when the cost increases by 15%. So I am going to measure the sensitivity of factors in terms of adverse effect, correct? So what is the adverse effect in terms of revenue? The revenue has to fall, the cost has to increase. The discounting factor, which is the cost of capital or the expectation of investors, also has to increase. It will not be everything to fall. It will be the revenue which is going to fall and the cost which is going to increase. Now, for NPV to 0, revenue has to fall by 20%. For NPV to 0, cost has to increase by 15%. For NPV to be 0, discount factor has to increase by 35%, which means which factor is most sensitive? With 15% fall increase in cost itself, NPV becomes 0. Okay, which is quick for touching the 0 line. For touching the 0 line, the revenue has to fall by 20%. For touching the 0 line, it is enough that the cost increases by 15%. For touching the 0 line, it is necessary that the discount factor increases by 35%. So based on this comparison, you will conclude the cost is the most sensitive factor. This is one way of measuring sensitivity. There is one other way of measuring sensitivity for the project where you will have a change in the factors which is given to you. The change in factors will be given. Say suppose 5% fall in revenue. 5% fall in revenue will give you a fall in NPV also. Likewise, they will give you, say, suppose 10% increase in cost, for which you will again find a fall in NPV. First, you will find the NPV for the project, which is the estimated NPV. Then compare with the revised NPV to measure how much is the fall in NPV. After measuring the fall in NPV for 5% fall in revenue, what will happen? You will first find revised NPV. After finding revised NPV, you will measure fall in NPV. From the original NPV, how much is the fall in NPV? You will find the percentage of fall. When you find the percentage of fall, you will compare that percentage of fall to say which is the most sensitive factor. The most sensitive factor will be the most which is adversely affected. So here when I took NPV as 0, I took the nearest number. But in case of change in NPV, it is not absolutely 0 now. In case of change in NPV from one number to another, but of course in a declining trend, you will find a sensitive factor which is most affected. Most affected for fall in the factors or adverse effect in factors will be regarded as sensitive. Okay, so let me give you a numerical example. As regards your class, I will be discussing all sums from your study material. Your entire study material will be covered. I will be giving some extra sums as worksheets during the class. I will be giving some extra sums which you can do it on your own. And once you finish, you can submit it to me. I will evaluate and give you the correct answers. So this is how we are going to take up the classes. Now coming to explaining sensitivity analysis using a numerical example. Just a minute, let me take the numbers. It is the numbers from a question picked from your study material itself. Okay, so Let me write down the numbers. The cost of the project. The cost of the project is 400 crores, which is given to us. They say not 400 crores. That is a different sum. After this sensitivity analysis, I will explain about equity IRR and project IRR also. Okay. See, suppose the project cost is rupees 1 lakh. And they say the life of the project is 3 years. They further say cash inflows. Cash inflows is 2 lakhs. They further say cash outflow is 1,50,000. Discount rate is 10%. And the question says measure the sensitivity of the project. If the question says measure sensitivity, here they have not told how much is the percentage of adverse effect. They have not told how much is each factor going to be affected by. Hence, I find a sensitivity for NPV equal to 0. Sensitivity is measured for a condition that NPV equal to 0. Now, what am I going to do? I am going to find the present NPV. Only then I will know the fall in NPV. Correct? So, to find the present NPV, you know the inflows is 2 lakhs. You also know the outflow is 1,50,000, which means the net cash flows is 50,000, assuming no tax, no depreciation, nothing. Okay. The net inflows is 50,000. Life is 3 years. So, present value annuity factor for 3 years at 10% cost of capital must be some number. Let me calculate that. Minus the present value of cash outflow, which is the cost of the project. The cost of the project is rupees 1 lakh. So I will find the present NPV for the project. Just a minute. Mute yourselves, please. The present value annuity factor at 10% for 3 years will be 4 years, and the present value factor years 1, 2, and 3 at 10%. So it is easy. 0.909, 0.826, 0.751. You all should be knowing this because you're all in the final level now. So it is 0.909 plus 0.826 plus 0.751, which is 2.486. So 50,000 into 2.486 will give us 1,24,300. Which means the NPV for the given information is 24,300. Since it is positive, you said accept the project and you took it up. Later, what is happening? It is all estimates. Which is all estimates? This 2 lakh is estimate, 1,50,000 is estimate, 3 years is estimate, 10% is estimate, 1 lakh is also estimate. The outflow is also estimated. What if the cost is going to rise due to inflation? During the course of executing the project, you have already taken up the project, you have accepted the project, and you have proceeded. You cannot drop it midway. Accepted project and you have proceeded. Now, to measure the sensitivity of factors. What and all could be the sensitivity of factors? Number 1, if it is for inflows. How much will be the NPV now? This inflow of 2 lakhs is now taken as X. X minus 1,50,000 into the present value annuity factor. I told you, while measuring sensitivity, it is only one factor which will change at a point of time. So I am keeping only the inflows unknown and the other factors I keep them constant. This is one particular number. Minus the present value of cash outflow is 1 lakh. With the change in inflows, how much should be my NPV now? I equate NPV to 0. Absolute adverse effect. Okay. So for NPV to become 0, how much should be my present value of cash inflows? It should be 1 lakh. Only then minus the investment, NPV will become 0. Equate for this equation. X minus 1,50,000 into 2.486 is equal to 1 lakh, which means solve for X. You will get X as 1 lakh divide by 2.486, which will give us 40,225.26. This minus 1,50,000, if you are bringing it to the right side, it will become plus 1,50,000. So you will be getting X as 1,90,225.26. This is the change in inflows or the revised inflows. This is the revised inflows, okay, for NPV to be 0. Instead of writing this as change in inflows, I will write this as revised inflows for NPV to be 0. If my inflows is 1,90,225.26, in which case my NPV will be 0. How much was your given inflows? The given inflows was rupees 2 lakhs, correct? Yeah, the given inflows was rupees 2 lakhs, which means how much is the fall in inflows for NPV to be 0? The fall in inflows for NPV to be 0 is 2 lakh minus 1 lakh 90,225.26, which is 9,774.74, which means what is the percentage of fall in inflows? The percentage of fall in inflows is 9,774.74 divided by the base inflows of 2 lakhs into 100 divided by 2 lakhs percentage, which is 4.89%. So if the inflows falls by 4.89%, you will have NPV to be 0. If the inflows falls by 4.89%, NPV will become 0. This is called as sensitivity of inflows. Likewise, you can find the sensitivity for other factors also. Let me find the sensitivity for one more factor to conclude which is most sensitive. Let me not do the entire sum now. So now coming to the sensitivity of, say, suppose the life of the project. Okay. Suppose if I'm going to take a sensitivity in the life of the project, the outflows also will remain the same only. Sensitivity for life of project. If I'm going to measure sensitivity of life of project, I find the revised present value of cash inflows. What is this revised present value of cash inflows? It is 2 lakhs minus 1,50,000, which is inflows minus outflows, into present value annuity factor at 10% for X years. What is those years? We do not know. Okay. At 10% for X years should be some present value of cash inflow. This present value of cash outflow is 1 lakh. Now I'm going to measure sensitivity. How will I measure sensitivity? I will measure sensitivity keeping NPV as 0. When NPV is 0, the present value of cash inflows is 1 lakh, which means 2 lakhs minus 1,50,000 into the present value annuity factor, I'm equating that X years is equal to 1 lakh, which means how much will be your present value annuity factor? The present value annuity factor at 10% for X years will be 1 lakh divided by 50,000, which is 2. Right? Now coming to annuity factor. I already wrote up the annuity factor. The annuity factor for 3 years is 2.486. So what is the annuity factor for 2 years? The annuity factor for 2 years will be 0.909 plus 0.826, which is 1.735. So exactly 2 is my annuity factor. It falls between the second year and the third year. So you will apply the technique of interpolation to find when the annuity factor is exactly 2. Interpolation is nothing but cross multiplying. Okay. So the present value annuity factor I am finding at 10% for the various years. At 10% for 2 years is 1.735 and at 10% for 3 years is 2.486. Okay, 1.735 and 2.486. Now, in between this 1.735 and 2.486, I will have a number, right? This number will be for a period between the 2 years and the 3 years. What is happening to the cost? With increase in life, the cost is increasing. From 2 years, at 2 years, the cost was 1.735. For 3 years, the cost is 2.486. This is the present value factor, correct? The present value factor is increasing for a period of 12 months. 1 year is 12 months. For a period of 12 months, it is increasing from 2.486 to from 1.735 to 2.486. 2.486 minus 1.735 for a period of 12 months, the increase in present value annuity factor is 0.751. How much is the increase in annuity factor you want? You want NPV to be 0. For that, how much is the increase in annuity factor you want? It is 2 minus 1.735. 2 minus 1.735 is 0.265. So cross multiply to find the period, and that cross multiplication only is statistically called as interpolation. For 12 months, 0.751 is the increase in present value annuity factor. How much is the increase in present value annuity factor you want? 0.265. For which, how long will it take? It is 0.265 into 12 divided by 0.751, which will give us 4.23, which means the life is 2 years, 4.23 months. That 0.23 months, you can later convert it into days. Or if you do not want to show like this, 4.23 months divided by 12 will give you 2.35 years. 2.35 years. There is a fall in the life of the project. Now, again, coming back to sensitivity of life. How much was the life which was given to us? The life given to us is 3 years. Now, the life is going down to 2.35 years only, because the life of the machinery, what if the machinery is going to break down? If the machinery breaks down and you cannot further continue with the machinery. Now, when I go and purchase a machinery, they say it has a life of 5 years, it has 3 years warranty, 2 years warranty. They say all conditions. What if it is not working after the warranty period? During warranty period, they will replace. What if it is not working after the warranty period? You will do some repair and maintenance activity and try to drag its life. What if it completely breaks down? It is not subject to any repair. So here, this sensitivity of life of the project from 3 years is now falling to 2.35 years. So what is the fall in life? The fall in life is 0.65 years. So what is the percentage of fall in life? The percentage of fall in life is 0.65 divided by 3 into 100. From the base value, it is the fall, correct? So 0.65 divided by 3%, you get 21.67% as the sensitivity of life. Now tell me, for the two factors which we calculated, which will be most sensitive? I found the sensitivity of inflows and the sensitivity of life. You can find a sensitivity for every factor. Now, when it is sensitivity of inflows, I calculated it as 4.89%. When it is sensitivity of life, I found it as 21.67%. Both this is the sensitivity for NPV to be 0. So, if you people can understand Tamil, எனக்கு 4.89% inflow குறைஞ்சாலே NPV 0 ஆயிடும். ஆனா லைஃப் 21.67% குறைஞ்சாதான் NPV 0 ஆகும். அப்படின்னா which is most sensitive? The inflows is most sensitive for NPV to be 0. Change in inflows is the most sensitive factor. Comparing these two is the most sensitive factor. What are you going to do by knowing this most sensitive factor? While accepting the project, you also measure for the adverse effect by finding the sensitivity of the factor. Later, while taking up the project, you will be more cautious about the most sensitive factor. You will be more careful about the most sensitive factor. So here I found the inflows is most sensitive. So I will make sure that there is no high adverse effect in terms of inflows. If there is a high adverse effect in terms of inflows, it will affect the profitability of the project. So this is when NPV is 0, where the sensitivity analysis is measured. There is one more way of measuring sensitivity, where let me give you a random example instead of solving a particular sum. Let me give you a random example. For 2.5% change in inflows, for the same 2.5% change in life, suppose they say the sensitivity is, I will find the revised NPV. After finding revised NPV, I will find the percentage of fall, like I did for NPV equal to 0. For 2.5% change in inflows, the sensitivity is, say, suppose 15%, which is the NPV is going to reduce by 15%. This is fall in NPV. And say, for 2.5% change in life, the fall in NPV is 25%. See what is happening? The change in inflows and change in life is constant. For 2.5% change in inflow, 15% is fall in NPV. For the same 2.5% change in life, 25% is fall in NPV. So which do you conclude as most sensitive? The most sensitive factor will be life. You will make sure the machine does not break down during the course of the project. You will take up sufficient maintenance activity to maintain the life of the project. So here you will conclude the most sensitive factor as the life of the project. There are not just few, there are many interesting concepts in the subject of strategic financial management for discussion. So as regards SFM, I stop the demo here. Now coming to strategic cost management. When it comes to strategic cost management, as part of your syllabus, you have marginal costing. You will have standard costing. You will have, as part of marginal costing, you will have transfer pricing. then you will have just in time, then you will have throughput accounting, you will have backflush accounting. Throughput accounting is accounting for constraints. You will be applying limiting factor in case throughput accounting. Limiting factor is what you study in marginal costing. Then you will have the concepts of statistical quality control, where you will have the X bar chart, R bar chart, and all that. You will have graphs there. Then you will have operations management. As part of operations management, you will have the usual OM content of intermediate level, where you will have the assignment, transportation, PERT, CPM, crashing, LPP, and all that. Okay, this is your syllabus. Transportation, assignment, LPP, then you will have crashing, PERT, CPM, all that. This comprises 100 marks of your paper, where operations management is for 30 marks and cost accounting will be for 70 marks. So today I thought I will give you an explanation on transfer pricing. What is this transfer pricing? Transfer pricing is the price at which the goods are transferred internally within the organization. Transfer pricing is the price at which the goods are internally transferred within an organization. If you are going to make an external movement of goods, you call it selling price. When it is internal transfer, you call it transfer price. Say, suppose there are 3 divisions in an organization, X, Y, and Z, where Z produces the main product and X and Y produces components. Example, automobile industry. Okay, Ford Motors or Hyundai Motors, whatever, right? So there are 3 divisions in an organization where X and Y division produces components and Z produces the main product. So what will X and Y do? X and Y will give components to Z, and it will also have a marketability for components outside. It will also have a marketability of components outside. Example, spare parts. So when you are buying a car, all spare parts are fitted in the car and sold to you. Later, after 5 years, if you want to change the spare part, that spare part is individually available at a market price. So what is happening now? Here, while calculating the transfer price, X and Y divisions having an individual market, they will have a selling price for their component in the external market. They will also have to render their components to division Z. If both X and Y has abundant capacity, there is no problem at all. I will produce, suppose, if the capacity of division X is 1,000 units and it has an external market of 500 units, it can sell the remaining 500 units at transfer price to division Z. What if division X is having an external market for 600 units, in which case I can meet the requirement of Z only to the extent of 400 units. If there is no restriction on 1,000 units, you can meet the requirement on both sides. But generally, every division will have a normal capacity, will have a maximum capacity. Considering that normal capacity, for the first instance I told you, if I have to honor the external market to the extent of 500 units, the internal division will be given another 500 units. What if my market demand is 600 units? I will not be able to honor the internal division. When I don't honor the internal division, what will happen? There will be misunderstanding. Why? Because it is coordination among the divisions which will enhance the profitability of the firm. In which case, this division X has to forego, this division X has to forego the market demand to meet the internal requirement. Where in that case, to meet the internal requirement, when it is foregoing market demand, it will have an opportunity loss. So, while calculating the transfer price, it will be the cost for the units plus the opportunity loss, which will be recovered from the division, because what is here required? The normal capacity is 1000 units. If the external demand is only 500 units, I can give 500 units happily to Z. But what if the external demand becomes 600 units? I will be able to give Z only 400 units, but Z wants 500 units. So what I will do? I will forego 100 units of external demand. When I forego 100 units of external demand, I will have opportunity loss, which means what will be the price at which the components will be transferred to division Z? It will be the cost for the units which is transferred along with opportunity loss. What is that opportunity loss? It is the benefit foregone because of honoring the division and not accepting the market demand. Okay. So here again for transfer pricing, I will do one sum from your study material itself. So just a minute, let me take that sum. Just a minute. Okay, so I am taking a sum from your study material where they say there are 3 divisions X, Y, and Z. The selling price of per unit, the selling price per unit for each division is 48, 46, and 40. They have given certain variable cost information. That variable cost is given as 33, 24, and 28. Which means the remaining difference is what we call as contribution per unit. That contribution per unit will be 15, 22, and 12. Suppose they say there is a limiting factor of labor hour availability. So here the limiting factor is not on the capacity, it is on labor hour availability. Suppose they say the labor hours required per unit is 3, 4, and 2. In which case, what will I do? I will find a contribution per labor hour and rank the products. So ranking of products will be 15 by 3, 22 divided by 4, 5.5, 12 by 2, 6. So now to rank the products based on the limiting factor, Z will be given first priority, next is Y, and last will be X. Okay. Now, as a continuation of the question, they say product Y. There are 3 products. These are products. Okay. Product Y is to be transferred to division B. How much is the requirement? Maximum quantity that might be required for transfer is 300 units. This is the maximum requirement of transfer. Apart from Y being transferred to division B, they also have an individual market. The products also have an individual market. They say the units, which is demand, the demand is 800 units, then 500 units and 300 units. Okay. So instead of receiving the transfers of product Y from division A, division B could buy a similar product in the open market at a slightly cheaper price of rupees 45 per unit. So instead of transfer, division B can buy from open market at rupees 45 per unit. Okay, they are saying what should be the transfer price for 300 units of Y if total labor hours available in division A is 3,800 hours. The total hours available in division A is 3,800 hours. Based on the rank priority, I will honor the production, right? First, I will take up Z because it took the first rank. How much is the demand for Z? 300 units. For every unit, how many hours is taken up for Z? 2 hours, which means 600 hours goes for Z. So 3,800 minus 600, you will end up with 3,200 hours. After Z, you will give for Y. For Y, how much is the maximum demand? 500 units. For every unit of Y, it needs 4 hours, which means you need 2,000 hours for Y. This is for meeting the external demand. Then coming to hours available for X. Hours available for X is only 1,200 hours. See, how many hours is required for X for the external demand? Hours required for X for external demand is, how much is the maximum? 800 units into, how much is the hours required per unit? 3 hours, which means you need 2,400 hours. Now, to meet the external demand itself, you do not have sufficient time. Then where are you going to take the transfer? So, the hours required for transfer of Y, hours required for transfer of Y to division B. How many units of transfer they said? 300 units. For that 300 units, how many hours per unit? Per unit of Y requires 4 hours, which means this requires 1,200 hours, right? Now, I have only 1,200 hours available. I can either give it to Y for division internal transfer, or I can honor the external market. I cannot do both. So, which one will I choose? I will choose to honor the internal transfer only. Why? Because that available 1,200 hours, if I take it up for X, what will happen? I can meet only 50% of X's demand. For meeting 50% of X's demand, I will be getting a contribution of 15 rupees per unit. Instead, if I honor that 1,200 hours for internal transfer, it is for Y. How much is the contribution per labor hour for Y? It is 5.5. The contribution per labor hour for X is only 5. So, instead of meeting the external demand of X, what I do? I give that available 1,200 hours for Y. Instead of meeting the external demand of X, I give that available 1,200 hours to Y because the contribution per labor hour for Y is more. Now coming to finding the transfer price, I have decided that it is profitable to transfer the available hours for Y instead of meeting the external demand of X. Because we compared the contribution per hour. Now, this hours required for transfer of Y is 1200 hours. It exactly matches. So, what is the transfer price? The transfer price will be, which product am I going to transfer? Y. What is the variable cost per unit of Y? It is 24. Because of this internal transfer, what is happening? You are foregoing 50% of demand of X, because X required 2400 units. With 1200 hours, you could have honored 400 units, 50%. You are foregoing 400 units. You are foregoing 400 units of external demand of X, correct? When you are foregoing 400 units of external demand of X, and for each unit you are foregoing 15 rupees of contribution, you have an opportunity loss of 6,000. That opportunity loss of 6,000 is to be recovered from 300 units, which is used for internal transfer, which means the opportunity loss to be recovered will be 20 rupees per unit. Let me put it up here. So what happened? With 1200 hours available, I could have met X external demand to the extent of 400 units, correct? Because of this internal transfer, I have an opportunity loss. How much is my opportunity loss? External demand for X is 400 units, and for every unit I could have made 15 rupees as contribution, which means 6,000 is the total opportunity loss. This 6,000 of opportunity loss will be divided by 300 units, which is meant for internal transfer, which means 20 rupees is opportunity loss. The transfer price is rupees 44 only. But instead of transfer, if they are opting for buying the component from the market, it is 45. Hence, you will conclude the transfer price, even after considering opportunity loss, seems to be economical compared to buying the component from the market. So, for further knowledge seeking classes, I will meet you all in Adhyapana Academy. Thank you all so much. For any clarifications, please ping me personally. You have my number. For any clarifications, please ping me personally. Thank you so much.